In our panel discussion on this Tuesday, we address matters related to the financial and foreign exchange markets amid the resurgence of COVID-19 across the world. I have Professor Kim Se-won from Ewha Women's University. Welcome back, Professor Kim.
Pleasure to be here.
I also have Professor Oh Jun-seok from Sookmyung Women's University. It's good to see you again, Professor Oh.
Thank you for having me.
Professor Kim, let's begin with the reason behind the U.S. Federal Reserve's decision to double the pace of its tapering and to pave the path for greater interest rate hikes next year.
U.S. prices rose by over 6% in October and then further rose by 7% in November, which is simply the highest in 4 decades. This high inflation increases the pressure to start raising the key interest rate by U.S. Federal Reserve, even though U.S. economy is not fully recovered from the pandemic yet. Early this year, actually, Mr. Powell, the Fed chairman, argued that this high inflation reflects the bottlenecks from a disrupted global production chain. But after reappointed as a Fed chairman in November, he changed his mind, and he said that this high inflation could be more persistent than he only anticipated earlier. So since U.S. Federal Reserve is the first job is fight against the inflation, U.S. Fed will use all tools, monetary tools, to fight against inflation. That means the tapering could be faster than before, and the interest rate hike will come earlier than expected.
Right. So along with this plan, they're hoping to end bring all asset purchases, that is, to an end by March 2022.
Exactly.
Right, I see. Keeping in mind what Professor Kim has said, Professor Oh, what are your thoughts on the implications of the Fed's tightening of its monetary policy amid the presence of Omicron on foreign exchange and financial markets?
As Professor Kim commented about, the U.S. Fed has started tapering. It began pulling back on the pandemic aid or the disaster relief fund. A surge in demand coming out of the COVID-19 recession, coupled with the supply chain disruption and labor shortage, which will create a perfect storm of price increase. And then eventually, the interest rate hike will be expected next year. I mean that in 2022, because to curb down the inflationary pressure. And then when the interest rate gap between the United States and Korea have to keep the balance. When it lose the balance between two countries, it will be another financial crisis might happen. So everybody knows that BOK will follow the U.S. Fed changes of interest rate, which means that the interest rate hike. So it will drag down the business sentiment in Korea. Accordingly, the government in Korea have to provide the private sector with some incentive to make more investment. And about half of the major Korean companies have no investment plan next year as they battle uncertainty around the disruption, as Sonny commented about the Omicron variant pandemic has created. According to Korean Economic Research Institute, 49% of companies responded to the survey said they either do not have plan to make a new investment in 2022 or have yet to come up with one. In short, the spread of Omicron variant will add to uncertainty in the financial market, highly vulnerable to the peaky volatility of the stock price, not to mention foreign exchange rate markets next year.
And despite those concerns, Professor Kim, a $60 billion US currency swap deal between Korea and the US is slated to expire on the 31st of December. But before we delve into that matter itself, could you tell us a bit about a currency swap deal and its purpose, please?
Of course, it would be better if we can extend the $60 billion currency swap with the United States, because it is a very important financial market stabilizer to Korea. But one thing I think fortunate is that it has been terminated right after the shock from coronavirus pandemic has been weakened. The Bank of Korea and U.S. Federal Reserve signed the $60 billion currency swap in March 2020 last year. to ease financial market anxiety and instability caused by coronavirus pandemic. And partially thanks to this currency swap with the United States, Bank of Korea provided $20 billion total US dollars to domestic commercial banks without any problems. And that really helped the stability of the Korean financial market for the last 2 years.
Right. The Bank of Korea, Professor Oh, has said the currency swap deal will not be extended. It was extended about 3 times, I believe, right? But this time it will not be extended as, now I am quoting, financial and economic conditions both at home and abroad are stable. What are your thoughts?
Bank of Korea made this brief explanation for expiring this currency swap. Shortly, it is because the financial and economic situations at home and abroad remain stable and expected to keep stable. But once we remember that the currency swap take the role of safety net in an economy in time of uncertainty, let's think about it. Does it make sense when you say that it is of no use anymore? Because I've never used the airbag in my car while I've been driving for 10 years. It might be hard to believe, though the remarks are apparently backed by the fact that nation's lucrative foreign reserves, which is about $469 billion worth as of end October. BOK might make a financial prediction in the global market and calculate the numbers and then count it, the possibility depending on the scenarios. And finally, the Bank of Korea made the decision, thought of themselves, their very best bet is to hold on flexibility and independence of their monetary policy rather than to be hooked up by the safety net in the domain of international cooperation or the coordination. I wonder what makes independence of policy better than the interdependence of monetary policy. Theoretically, it's right. Sufficient foreign reserves are crucial for global-oriented economy amid the U.S. Fed rates hike, as U.S. monetary move could increase debt burden and trigger capital outflow that could lead to a financial crunch. But sentimentally, it feels uncomfortable, though some experts largely agree the Korean economy at this point has a stable situation, but they also expressed the concern watchful of the future unexpected woes. So we have to prepare for this kind of unexpected woes. So count me in the group who need seatbelt in the car, regardless of driving speed or road condition, under what situation might be.
Right, a very interesting metaphor, Professor. Professor Kim, what are your thoughts on the matter? Do you believe that conditions home and abroad, speaking in terms of finances or economy, are indeed stable? I mean, do we have enough sufficient amount of foreign exchange reserves?
Yes, that is a very important question, Sunny. Actually, we maintain enough and diverse buffers against financial instability generated by the shortages of US dollars. The buffers are enough foreign reserve held by Korean government. And second is Korean residents enough foreign currency deposits on domestic commercial banks. And the last buffer is continuing trade surplus from the gap of export and imports. At the end of November, Korean government's foreign reserve amounts to $464 billion, which is 5th largest in the whole world. And secondly, Korean residents' foreign currency deposit increased in the highest level in history, up to $103 billion as of November. So this fast increasing Korean residents' foreign currency deposit on domestic commercial banks has been generated by domestic corporations. And this is totally related to increasing and robust export of Korean companies. Since they earn lots of US dollars from export, they deposit their US dollars to domestic commercial banks. So we don't have to necessarily worry about the shortages of US dollars after termination of the currency swap with the United States.
Right, as long as our exports remain quite robust
Right.
then. Professor, some pundits, like yourself of course, are calling for yet another extension of the currency swap deal, claiming it offers a psychological sense of security, especially amid the pandemic. I'm assuming you share these thoughts. Tell us more.
Sonia raises a good point. It could make sense, I say, that currency swap arrangement, rather than a source of financing, it would help to stabilize the financial market psychologically and prevent the pandemic from causing a global economic drought. Other than the swap arrangement with the United States, Korea also have a bilateral currency swap arrangement with 8 countries, including Australia, Canada, and China. They are all set to expire this time. I got another metaphor. I got a credit card with a monthly credit limit of $5,000. The fact is, I never used the credit loan, but it might not the same situation whether I have a credit card with or without maximum affordability to get a loan under uncertainty. In this sense, it would be noteworthy that Japan and China extended a currency swap arrangement, also signed in 2018 for 3 years more to October 2024 as part of effort to ensure the financial system stability. So I think to make an extension is much easier than to make a new arrangement from the start. So it's a strong signal to the market. It's a symbol of solidarity in the financial system. I suppose it should have to be extended for Korea. It's ready to handle foreign exchange crunches in the future with prepare the system with the alliances.
Right, and perhaps to address the potential psychological fear factor then. Moving ahead, Professor Kim, what are the chances of a further hike in its key interest rate by the Bank of Korea next month, following increases perhaps later in the year by the US Federal Reserve as well?
Well, the timing of Bank of Korea's interest hike really depends on the development of the variants of COVID-19. As inflation exceeds and continues over 3.7% on year in November, Bank of Korea puts higher priority in stabilizing inflation rather than recovering economy. But if economic recovery weakens by the end of the year, there is a possibility for Bank of Korea to reshuffle all policy priorities. That means they can delay interest rate hikes when economic situation gets worse until the early next year. So I think the first signal of delaying the interest rate hike by Bank of Korea would be less than 4% economic growth for this year, which is the target economic growth for this year. So when economic growth and employment situation get worse by the end of the year and early next year, I think there is a high possibility that Bank of Korea will delay the interest rate hike by second half of the next year.
Right, so Omicron does appear to be a very big variable here.
Exactly.
Right. Professor, also on the local front, what are your thoughts with regard to the impact of our fresh set of COVID-19 restrictions on domestic demand?
It must be a hard hit to the economy, returning to the lockdown. Korea's economy will grow 30.1% in 2022, according to the finance ministry. Nobody's sure about that. But the Omicron variant could cause a bottleneck in the global supply chain. That could affect inflation hike, as Professor Kim commented, and investment to drop simultaneously. So I have the same view with the finance minister that the domestic demand increase is crucial for Korea to achieve expected economic growth of the 3.1% in 2022. But the biggest change next year is to get rid of the maximum limit of Korean purchase from the duty-free shop in place since 1979. And to boost the economy, the government plans to maintain its tax credit program, income tax credit for credit card spending 15%, and for debit card spending 30%, and for spending at traditional market, it's a bonus. It's a 40% of income tax credit. For a small business, the government will continue with its program until the crisis situation ends, including raising the minimum amount of the compensation for business losses from 100,000 won to 500,000 won, and 35.8 trillion won worth of supportive loan at lower rates are provided. But I wonder whether it could convince people enough to be a comfort in the middle of Omicron variant.
Right. Professor Kim, Professor Oh mentioned the government forecasting that the economy will grow by 3.1% next year. He also mentioned nobody knows. Do you know? What are your thoughts? Is this a feasible target?
Well, 3.1% economic growth for next year is pretty much government's own expectation and hope, I think. If we grow by over 4% for this year, 2021, that means Korean economy is fully recovered from the pandemic. We goes back to the status of before the pandemic. So from the normal status of the economy, it is extremely difficult to grow over 2% because our potential economic growth is 2%, which is called by full capacity economic growth. So if we want to grow over 2% in Korea, there should be very high inflation because there is a trade-off between inflation and economic growth. So government's forecast of major macro variables of economic growth of 3.1% and inflation of the 2.2% is pretty much conflicting to each other. So I believe that 3.1% economic growth for next year is pretty difficult if government wants to get the two targets at the same time.
I see. Meanwhile then, Professor Oh, Korea is poised to place next year's priority on stabilizing the local economy. Is this a possible scenario then, given the presence of Omicron and the ongoing disruptions in the global supply chain?
Well, there are many things to be considered under uncertainty, but I could suppose it could be understood the policy direction is on the right track. And the focus of government policy is to achieve economic normalcy beyond the pandemic crisis, alongside taking the lead in the global competition. It is to the point that the momentum of resilience comes from promoting international trade and then investment. So the government forecast export target increasing over 2% and import target of 2.5%. But two main tasks to be solved to attain this goal next year might be one is to boost up the private consumption, and the other one is employment opportunities altogether. I may see the chances of recovery in jobs that require direct interaction with customers in 2002. The government are trying to find a solution in the tourism sector. So tour promotion would be pushed in consideration, in cooperation with the local government's environment on the basis of stabilizing the consumer prices and supporting those micro business owners hit hard by the prolonged social distancing. But what is worried at this moment is that most of the policy direction has been focused on the first quarter of 2022. We already know that March 9th is a presidential election, and the next automation will take office slated for May 10th. So the timing of the targeted policy might be politically moving from here and there like that. And another risk factor to be noted, it might be rising household debt, which will be a burden for consumers and a hurdle for Korean economy to overcome in the near future.
Right, well, these are definitely hurdles that would need to be overcome then.
Right.
All right, Professor Oh, as always, thank you very much for your insights. Professor Kim, thank you very much for your thoughts.
Thank you very much.